Thanks for joining us for the executive series. Today I'm speaking with Marcus Burns, who is the portfolio manager at Spheria Emerging Companies. Marcus, it's great to talk to you.
Thanks, Tom.
Particularly at a time where there's a lot going on in the small to micro cap space. Let's talk about the relationship between the macroeconomic environment and what that can mean as far as an emerging company is concerned from your lens.
Okay. So, look, I think there's a couple of questions within that question. We're like small companies and micro cap companies are probably more exposed to the economy, I think, than say larger companies. A few reasons for that. One is that they're typically single country focused. They're not multinational, generally speaking, and they're usually single product focused or single strategy focused. So they feel the cold winds of the economy changing a lot faster than the large companies and not as diversified. So we've seen a few companies get sold off pretty strongly in the last 6-12 months, particularly down the microcap end, where I think capital's come out of that space, and they've been feeling chills. The economy's slowing down. The housing cycle's obviously slowed. And so we're starting to find more value, particularly down the bottom end. So the smaller the company, broadly speaking, the better valuations we're finding at the moment.
Right. So when you look at the Australian economic picture, things aren't too bad. Job creation's strong, interest rates are low, inflation's contained. You think that would all be working quite nicely for the smaller organisations?
Sounds pretty good, doesn't it?
Yep.
We've had this little thing you might have heard of called the Hayne Royal Commission, which I suspect is probably slowed a lot of the lending down with the banks, and just the scrutiny on the sector has probably seen capital being raised by banks and reinvested by banks and loaned people obviously impacted, and that's had a secondary flow onto housing prices and then a secondary flow into confidence for people spending. So I think we've seen a bit of that going on. And you might also argue we're possibly at peak cycle. So we've had very low rates for a long period of time. We've had a very strong stock market for a couple of years and a very strong housing market, all of which look like they might be coming off a little bit. So that tends to flow into people's considerations about future expectations of future spending, which obviously comes back to spending and so a lot of things in retail and the media sector have come off pretty hard on the expectation that we might see a slowdown in revenue growth in some of those sectors.
Okay. So in terms of the reporting season. What are you going to be looking at most closely when it comes to these smaller organisations?
That's a good question. I think we go back to the basics every time. We don't tend to. Our philosophy is to look for companies that make good cash conversion and good cash flow, and have good balance sheets. So we tend to dumb it down to very simple things. We're looking just to cross-check and proof up the stocks we own, have all those kind of criteria and qualities present. We're looking for opportunities. So if stocks report and they get sold off aggressively, maybe too much so, based on some short-term news flow that we don't think is long-term, we might look to change portfolio and buy some of those shares. Equally, if stocks rally really hard on a good set of numbers, we might be looking to sell. So,
you're quite mobile.
We're mobile, tend to get opportunities to both buy and sell, and hopefully you sit on the right side of most of those movements. But as I said, we stick to the basics and what we're doing, and we try not to get too complicated around results period. It's so busy, right? We've got 250 companies reporting. You've got to keep it pretty simple.
Yep. And in terms of your overall strategy, you seem to be getting taken out of some of your investments with, literally with takeovers. That must be quite an encouraging validation of your screening process.
Yeah, it is. It is. I guess it's a positive for the firm and for the fund, obviously. But we sort of had a number of stocks being taken over. Trade Me was one that got bid for last year by some New Zealand company like an eBay of New Zealand, and got bid for by Apex Partners out of the UK at a big premium. And then we've had Helios being bid for by Jang Ho. We've also had Green Cross being bid for by private equity. There's been quite a few in the last quarter that have received some interest. I guess the main reason for that is that the acquirer is looking for stocks that have good cash flow, because they typically use a lot of funding on the other side, so they need cash to pay the debt off. They like balance sheets that aren't already too geared, because obviously if the balance sheet's got debt, they can't really add much to it. And then obviously they want to try and buy it at a cheapish valuation so they can make money out of it when they eventually sell it off or refloat it or break it up or whatever they're doing with it. So they tend to be the kind of things we're finding and looking for in our portfolios anyway. And it's a nice validation to have. And also Navitas, right, last one, which was a big holding for the SEC. It's also under takeover as well by a founder and BGH. So there's been a lot of activity, and whilst debt costs remain low and private equity is active, I think that theme will probably continue for maybe 6, 12, 18 months. It's been a good validation.
Are there any areas that you're avoiding like the plague?
Like the plague.
Maybe the plague's a bit strong because we haven't had one for a while, but are there any areas that you're wary of?
Yeah, look, we're I think we're wary of, in a small cap space, consumer finance stocks,
Right.
where their reliance on, one, the economy holding up,
Yep.
bad debt cycle not being too bad, and three, intermediary funding, so the banking sector and the stock market being open to raise capital. And so that makes them pretty vulnerable to compressions in margins, and they might struggle to raise capital in a more tough environment. So we tend to avoid that sector. We don't tend to like sectors or stocks that don't have, as you probably know, Tom, free cash flow. So that rules out some of the emerging resource companies.
Yep.
The gold sector is not a favourite of ours, for example. And then biotechs and small companies that don't make cash flow. We tend to avoid those until they prove themselves
Yep.
with a business model that makes some sense. So we're avoiding them, I guess, a bit like the plague, no pun intended. And then, on the flip side, we're finding opportunities probably, it might be a bit early, but we're seeing on the cyclical side of the economy, so as I said, some of the media names, some of the retail names, particularly, that have been pretty hardly hit in the last 6 months, they're starting to look like some value in that sector, maybe a bit early because obviously we haven't seen the earnings come through. This half might be challenging, but I think there'll be some good chances over the next maybe 6-12 months to find some good names in those two sectors.
Is there a particular area that excites you a lot in terms of the prospects for the next couple of years?
Look, I think anything that's any small company that can generate sustained earnings growth in Australia and maybe start to expand internationally. So if it's got a good home product that's pushing international and it's got some success in some foreign markets, I think that's a really good sign. So stock we have that fits that bill is Technology One. I think I might have talked about that to you that last time I came on the show. It was beaten up last time because it had a tough first half result, and it's recovered really well since then actually. So it's been a good stock performer for us. We've sold back a little bit of our position, but that's a great company, a great home market, incredible history of cash flow generation, really good, really well managed, and it's pushed into the UK, and so far looks like it's getting some traction there as well. So that's the kind of stock you could see compound for many years to come. And I think there'll be others in the tech space, particularly, that do manage to come out of Australia, but there'll be few and far between. But there's definitely some opportunity there.
Marcus, it's a great insight that you've offered there. Thanks very much for your time today.
Thanks, Tom. Good to see you. Cheers.
And thanks for joining us for the Executive Series.